I'll pause after we just go over the payback period, and then we'll go over some examples together and what the payback period is. So the idea of the payback period is it's one method. All of these are just methods of capital budgeting. How do we make decisions? And so this is a pretty simplified method. So the payback period of an investment is just the period of time it takes to recover your investment. There's a lot of problems with this. This is a very simplified calculation because it doesn't take into consideration the present value of money. So we'll be talking about that in more detail in future slides, but just remember, back to financial accounting, money today is worth more than money next year. If I was to ask you a question, if I could give you $1,000 today or $1,000 a year from now, most of you, I would hope, would want to take the money today. Why would you want to take that money today? Because you can use that money to go invest it in other products or investments and then make more money in the future. If I invest $1,000 today in the market and the market stays standard or investment, I can make $80 over the next year if there's an 8% return. But if I give you the $1,000 in the future, it's worth less because you weren't able to invest that money. So if we look at that future value of money and present value it to today, that's our present value. And so that rate that I use, that 8%, is our investment rate, and then our the future value is called that future value rate, and the present value would be that discounted rate. And so a lot of these first few methods we're going to use don't take into consideration that math. That's why I call them back of the envelope calculations. They're quick divisions or multiplications in order to determine, should I look into this investment sooner? But for payback period, we don't use the net present value of money, but we'll be going into that soon. So that's just a limitation of this. So for a payback period, we're just going to be looking at what does it cost me and how much money do I get from it annually, and then how quickly can I return my investment. So this is a very standard calculation I've seen for real estate, for purchasing real estate, where we decide, okay, here's my initial cost, and then if I rent out the piece of real estate, how quickly do I make my initial investment back? So there's one practice question here, and this is a payback with even cash flows. We're going to go into non-even cash flows later, or differing cash flows. The question here is, Fast Track is considering to buy a new machine. The cost is $16,000. The useful life is 8 years, and the expected annual cash flow is $4,100. All we care about here, and I expect you to memorize this for your exams, the payback period, we have the cost of the investment over the annual net cash flow. And so we can see that in our sheet here. If we go to payback period, we go into our payback period, we can see the cost. We can play with this cost of investment and with the annual net cash flow. So this is tab 2, cost of investment and annual net cash flows to get the number of years. And so this is just a simple division of B2, like the cost of investment, by the annual cash flows. And so if we put this side by side, what was our cost of investment? Our cost of investment is $16,000, and our annual cash flows is $4,100. And so our years is 3.9 years. It's a simple, so you could change this. So you could ask yourself this for college degrees, right? If you say, my college, if I get a 4-year degree, I know it's going to cost me $40,000. But after that, I know I'm going to make $60,000 a year after taxes, let's say. We know that your college degree is going to pay for itself after that investment, and not taking into consideration your time, in 0.67 years, right? So we can see, wow, that's really great. This would be a great decision to go get your college degree, right? This is one way to do it. But then if you come back to me and say, well, that doesn't take into consideration all the other money I could have made while I was going to college, and that doesn't take into consideration if I invested that money in other investments, I'd say, yes, you're correct. And that's the limitation of the payback period, right? So this is the limitation. It just gives us some kind of metric to say, yeah, I should look into this further because I can make my investment back pretty quickly. So feel free, this is your own calculator, and we can go over it in more detail. I see there's a question, so I'm going to stop right now. I'm going to stop sharing and pause. Let's see. So we talked about even cash flows, but we have an issue of normally we don't have even cash flows, right? We have this concept of uneven cash flows. And the good example is we talked about when I'll go over college degree. That's to make it a little more applicable, but we can also use the book's example first. So what happens if we get different amount of cash flows over the next over the life of the piece of equipment? And so Fast Track wants to install a machine that costs $16,000 and has an 8-year useful life with a $0 salvage value. So we can't sell it at the end of its useful life, but we expect to make some money. Annual net cash flows are as follows. And so we see the first year, right off the outset, we got to spend the $16,000 to get it, right? And then we start a ramp. We make 3,000, 4,000, 4,000, 4,000, 5,000, and then it starts to lose its value. So we expect it to ramp up to a 5,000 at year 5, and then ultimately we'll start to ramp down. So when do we break even, or when is our payback period for the simplified calculation? And so the idea here is we just go, and I'm going to do the math with you all. We'll just see with what year it's in. And so 16,000, and then if we add these two, this is our initial outlay. We'll just continue to add. So now I'm adding negative 16,000 plus 3,000 plus 4,000, negative 16,000 plus 3,000 plus 4,000 plus 4,000. We're still negative, right? So we know it's more than 4 years. Plus 4,000 plus 4,000, and then plus this other 4,000. It's taken us some time. And then we can also take the cumulative here. And then so, okay, we are going to get our payback period. This is year 0. Our payback period happens somewhere between year 4 and year 5. And then the question here is, how do we calculate when in year 5 using the payback period? So we know this happens in year 4, right? And so we know it's year 4, but year 4 point what? And all we do here is we know it happened at $1,000, and then we divide that by the 5,000 to get our 0.2. Here we go, 0.2. And so the 4.2 would be years. So this is the it would take 4.2 years using this uneven cash flow. And so that's what you'll need to do. Make sure that when you're in a quiz, you don't simplify it and take some average method here. You have to go year by year. And now hopefully you can see that this makes it a little more complex to do. Once you start doing a calculation like this, I would default to say, why don't we do something more like an accounting rate of return, net present value, or internal rate of return, because we have these advanced calculators that can give us a kind of a better estimate. And so we can also use this as an example for college degrees, right? So I could ask you, it's a 4-year degree, year 1, year 2, year 3, year 4, and we can say our expected cash flows. We could take into consideration maybe you'd have a job, and it costs $10,000 a year. So we could say maybe negative 40,000 is something that you'd miss out if your first 4 years. But then afterwards, 5, 6, 7, 8, 9, 10, we can assume that you'll be making 80,000. And I can ask you, what would be your payback period for this? Right? And we can change this up. I just want to show you how it's useful. And we just take the cumulative. So this would be our cumulative cash flow. And this plus this. Okay, 60. And so we see that we'd make our money back in this situation at the end of year 6, right? So, and then we start having a large cumulative cash flow going forward. This was the right decision to make. So we can play with these metrics, but just to show you how it is simplified, it's not taking into risks or rates of return, but it's an easy way for us to make a calculation in order to determine if an investment is worthwhile and how long it'll take. So I'm going to stop recording for a second, and we're just going to go straight into going over some examples and some questions with the class before we move forward into accounting rate of return.